Good morning. That's right. I'm joined now by Richard Hope, head of EMEA and global head of investments at Hamilton Lane. Richard, thank you so much for being with us.
Morning, Juliana.
So you at Hamilton Lane invest all across the private markets. You've got exposure to private credit, private equity, venture. You recently said that the global playbook doesn't work anymore. What playbook does work when it comes to private markets?
Sure. Thank you. So, we're here at SuperReturn, and despite everything that's going on with the global macro right now, private markets is open for business. So yes, we may have said we were questioning some things around liquidity, some things about the industry dynamics. I think three things for us that are super exciting right now. The secondary market is hot, it's on fire. The second was the infrastructure market, driven by government investment. We're here in Germany today, 500 billion for infrastructure. And then the third, on the Evergreen side, this industry is wrestling with how to bring more private wealth investors into the asset class, and Evergreen's a big answer for that.
Now, it's interesting that you say you bring up secondary markets, which have been incredibly hot right now, as it sounds like a good thing. But the reality is secondaries have become so hot because LPs are struggling with liquidity. They're not able to realize returns, access cash, because PE is sitting on 30,000 unsold companies here. So talk to us about the outlook for secondaries and what we should read into what has become such a hot market.
Sure. So there's a big stockpile of companies. You're absolutely right. But also those investing into the secondary market really like it. It's shorter duration, it gives you nearer term liquidity, and it actually gives you an enhanced return. And so some investors are actually looking at this in a positive way, saying, I want secondary, I want to add that portfolio. On the other hand, as you correctly said, other investors saying, how can I keep investing? How can I keep my money at work? And they're selling into the marketplace. If we look last year, the secondary market, some $166 billion of portfolios were sold. That could be the LP or the continuation fund. This year, our deal flow at Hamilton Lane, up 60% on last year. So that's why I'm saying the market's hot. There's lots of people looking for liquidity. Some need it to pay bills. Others are looking at it and looking for it in order to keep investing into this asset class.
Another way that the industry is dealing with this liquidity crisis is the use of continuation vehicles. We're seeing that on the GP side. Do you think that trend is here to stay, the use of continuation vehicles?
Sure, so it's absolutely here to stay. It's grown enormously over the last few years. We're actually now in a spot where a number of the first generation continuation vehicles that were sold back in 2020-21 are actually coming through for exits. And the playbook back then was we're going to take some of our best assets, we're going to own them longer, and actually those continuation vehicles are now being sold. So we're actually seeing liquidity come back from CVs. And sorry, carry on.
Well, I was going to say, you're taking some of your best assets and putting them into continuation vehicles, but also the reality is it's taking some assets that simply, GPs weren't able to sell at the valuation that they wanted, so they put them into continuation vehicles.
Yeah, the cynic would tell you the stupid buyer is the secondary buyer. However, for many, it's an opportunity. The GP, remember, invests a lot of capital into these deals. We put their feet to the fire in terms of how much they're investing. And if we're aligned with them and they're investing a lot of capital into those continuation vehicles, we feel that's a good place to be right now.
How are you feeling about the outlook for Europe? It's dominated the discussion here on the ground in Berlin. Do you think that is a trend that's here to stay? And what do you think about the narrative that the U.S. is potentially seeing the end of its exceptionalism?
Yeah, so I think if you're a European GP at this conference, and there's 5,500 people here, as a GP, you're super happy right now if Europe is part of what you do. More meetings, more inquiries. The reality, however, is 70% of global private markets is North America. If I'm generous, I'll tell you 20% is in Europe. And so to move that even 5% would require an extra $500 billion invested into Europe. And the base today is $2 trillion. So that would be 25% more into European private markets. And I'm just not sure that the market can take that, and there'll be some indigestion. Now, the managers might take the money, but actually, how is that going to be invested? And so as investors, I think the global playbook still has to work.
That's so interesting. Why is it so hard for Europe to attract capital, put it to work? What are the major barriers to growing the European market?
So I think some of it's been culture, which is in North America, private markets is a bigger piece of the culture, private company ownership, holding your company, investing your company. That's been a big part of the DNA. It's less so here. In Europe, you have unions. We're in Germany. You have unions who perhaps want to have a say in how the business is run, which has been harder for private markets. It's also disparate. all these small countries mean you have lots of smaller country funds. If you're a big sovereign wealth fund, you probably can't invest into those funds because they're just too small.
Right, that makes sense. The other big theme that's coming up over and over again here is the democratization of private markets and spreading the investment pool, offering these investments to wealth clients in particular. Larry Fink, BlackRock chairman, recently said he thinks the optimum portfolio construction is now 50-30-20 stocks, bonds, and private markets. Do you think 20% is aggressive for a wealth client, or is that about the right allocation in your view?
No, I mean, for some people, they've made their money holding private businesses and they want to be reinvested in private businesses. So we see some wealth clients where it's 80, 90, even 100% of what they're invested into is into private companies because that's what's done well for them. I think bigger organizations are going to have something that's much more conservative. I think the semi-liquid or evergreen market is providing access route for investors to invest when they want and leave when they want. And one of the big things, one of the big, I would say, hang-ups of this industry is 10-year locked-up vehicles. You have to pledge your capital for a very long time. So you bring along evergreen funds, you can invest next month, you can redeem in a year, 2 years, 3 years, whenever you want. And you have seeded investments, and that's very attractive. 20% of our evergreen funds today, it comes from the pension funds, not actually the private wealth. This is institutional quality, best-in-class investments done in a flexible way.
Richard, thank you so much for the time this morning. That is Richard Hope, head of EMEA and Global Co-head of Investments at Hamilton Lane.